Hey guys, company. I'm actually trapped in my office right now for the impending doom of the thunderstorms outside and the rain that I don't want to mess up my hairstyle. So I decided to go ahead and do a video for your benefit, my inconvenience, but still yet that's okay. It's for all of our benefit whenever we all learn, because knowledge is power. So what I want to talk about was interest rates. This is a real common question. A lot of people, it might come down to a very simple explanation. Why do we all get different interest rates? Well, I mean, it really comes down to credit rating. Credit score has a big factor involved, but at the same time, not just credit rating, loan amount, the type of loan that you do, lots of different things. Debt ratio can possibly be a factor. There's a lot of things that factor into what your final interest rate is. One of the biggest things that confuses people are advertised interest rates on television. The reason being, I can't tell you how many times I've had a client come to me and, maybe we're doing their interest rate, maybe it's 4.25 for a USDA loan. And they come to me and they say, hey John, why is it that I got a 4.25% rate, but on TV they said that the rate was 3.5%. Well, when rates are advertised on TV, they have to advertise a base interest rate. Now, first of all, the rates on TV are generally going to be for conventional loans without any hits. A hit is whenever there's something that's outside of the norm, and it makes an adjustment to the rate. So say, for example, an interest rate on television is generally going to be figured for a loan amount above $100,000, a credit score above 720, and for a conventional loan. So anyways, loan amount, credit score, multiple different factors so that it could be, 20% down. So loan amount, credit score, 20% down. That keeps it to where it's conventional with no hits. And you can essentially advertise that interest rate to the masses, to anybody. Whereas the person that's coming to me and asking about their interest rate, why am I 4.25%, but I see on TV interest rates are advertised for 3.5%? Well, the reason is, first of all, you're doing a notification, had to stop it. The difference between the conventional loan being advertised on TV for 3.5%, if you remember, 20% down, 720 credit score, and loan amount above $100,000, for example. So then we've got someone who's asking me, why is my rate 4.25? Well, let's say you've got a 660 credit score. You're doing a USDA loan. You're putting no money down. So then these two loans are so far away from each other, there's not even a comparison. So advertised interest rates, first of all, you got to remember that you're looking at base interest rates that have not been affected by loan type, 20% down, loan amount. So all these factors can contribute to the interest rate. Now, USDA is a particularly confusing loan product when it comes to interest rate, because the USDA will put out a maximum interest rate. Now, we're all familiar with the concept of the person with a 700 credit score getting the better interest rate than somebody with a 600 credit score. Well, with USDA, when they post out a maximum interest rate, what happens is you might have two different people, 700 credit score, 600 credit score, but you can't go any higher than a 4.25% rate sometimes. So what winds up happening is everybody has heard about discount points. So when you cannot raise the interest rate for the person with the lower credit score, what happens is that interest rate becomes more costly. So you might have a person with a 700 credit score, USDA loan, they get a 4.25% rate, and that interest rate costs nothing. A person with a 600 credit score, same interest rate costs 2.25% maybe. So then, you're looking at $100,000 loan, $2,225 extra dollars in your closing costs for that interest rate. So we're all familiar with the concept of better interest rate for the better credit score, But with some loan products like USDA, a lot of times the same interest rate is given out for the better or the lower, the higher or the lower credit score, but the difference is in the pricing. That is the cost to the buyer for that interest rate. Now, let's talk about pricing of interest rates. Now, this is particularly confusing because, without a matrix to be able to show you how this works, I'm going to do my best to explain, because I explain it to a lot of people over the phone, and I feel like this is probably the best way to explain it to you here, because it's really all I have to go on. You're not in my office, you don't see pricing for interest rates, and it's something that I generally have to explain over the phone or verbally. It's not something like a show and tell. So what changes on interest rates, just about every interest rate is available at any time. Meaning that if you're doing a VA loan, for example, I have available interest rates for you right now between 3.25% and 5.25%. Now, what happens is that each one of these interest rates, between 3.25% and 5.25%, they come with a unique price. Now, the price is either what it costs for that interest rate, or that interest rate could give you a credit. Now, when I'm pricing an interest rate for somebody on a loan, I'm going to try to give them the lowest possible interest rate at the least cost. Because remember, this is not pre-housing crisis times. Loan officers do not get paid as a result of your interest rate. So, don't make the misperception that, the higher interest rate with this loan officer or this loan officer, this bank or whatever, that doesn't mean that, they are personally charging you more. In this day and age, we're set to a fixed rate of compensation based on the loan amount. The pricing of the interest rate is strictly between the bank, which your loan officer has no control over, and you. And so the loan officer, their job is to price that interest rate out the best that they can according to what your needs are for debt ratio, for payment, and what money you have available to spend. It doesn't always make sense to buy an interest rate down either, because you have to look at the cost of the interest rate to buy down versus how much it saves you monthly on the payment. So that can get into a whole other thing. But what I was trying to go off of is with interest rates, it's the pricing that changes, and it changes by fractions, eighths, 1/4%, so on. So this is why, when Wall Street does good, does bad, interest rates, the pricing gets better, gets worse. Now, we don't walk into, our office one morning and it's like, oh, interest rates were 4.25% today, and now the interest rate for today is 4.5%, or 4.25%, yesterday, and now it's 3.875. There's not a going interest rate. And the pricing, if you remember back to the USDA loan, when I was talking about the interest rate costing more for the person with the lower credit score, this is how the pricing goes. The pricing is different for different people, depending on credit score, loan amount, how much you're putting down or not putting down, loan type, all these factors play into it. So the pricing is what changes, and pricing can sometimes change for days before it makes sense to offer someone a lower or higher interest rate. Now, I know that this is confusing, but the best thing that I can tell you in these scenarios is if you're able to meet up with your loan officer face-to-face, I have no problem showing my clients a pricing matrix for interest rates. In fact, I had a client come by this morning, and I was grateful to, because explaining these things can be very difficult. But if you have a buyer that can maybe come by, they can look at a pricing matrix, they can actually understand what this is, because there's a lot of confusing information put out there in the media. Just advertising for various banks, bankrate.com, advertising 2.5% interest rates. I don't know what the APR is. I'm not with bankrate.com. But, there's a lot of confusing information out there. There is not a whole lot of difference for interest rates from bank to bank. The main thing that you want to look at when you're considering interest rates also is APR, annual percentage rate. Now, what that is that's a factor used in conjunction with your interest rate to determine if you get Sorry, I'm back. Someone called me. You may not know that. It does a pretty clean break, but I had a call. Anyways, so just like just a layman's example for an annual percentage rate is your interest rate, you have certain things when you buy a house that are called prepaid finance charges. These things are the charges associated with you financing a home. And so there are certain things that you would not pay for if you were paying for a house with cash. That's the best way that I've always come up with, make an analogy. Like, for example, if you were buying a house for cash, you would not have an underwriting fee. You would not have a processing fee. You would not pay a funding fee to the government. Things like that. Now, on the other hand, if you were buying a house for cash, you would have homeowners insurance. You would pay for abstracting. You would pay possibly a closing fee. I mean, there are different things, are and are not figured into the prepaid finance charges. So what the government does is it's kind of like an average. When you take 2 plus 2 plus 2 divided by 3, and you get the average, which is 2. So anyways, there's a formula for taking the interest rate, stacking on the prepaid finance charges on top, the things that are associated with you buying a home, and dividing it out over the term of the loan. And the result is the APR, the annual percentage rate. Now, if you were looking at an interest rate of, say, for example, 4.25%, you might have an APR of 5%. And the higher the APR, in contrast to the interest rate, the more fees are being charged on your loan. And this is like a tool that the government designed, to be able to identify a high-cost loan. And it's a tool for consumers. Not many consumers know this, but it's a tool for consumers to take a quick glance and compare available loan products. Like, for example, let's just say that you're out shopping mortgage loans, and maybe I offered you a 4.125% rate because they got great interest rates. And another guy down the street, he offers you a 4.125% interest rate. But you take both loan comparisons, and let's say that my APR with 4.125 is 4.625%. And let's say the other guy who offers you the 4.125% rate, his APR is 5%. So with his APR, I keep getting notifications. So even though you've got two interest rates that are identical, one APR is higher. The reason that is, without looking at anything else on that loan, is because, lender B, I'm A, he's B, he's charging more fees, more prepaid finance charges. He's got a higher origination fee, underwriting, processing, something. Something's in there that that even though that this guy has the same interest rate as the other one, he's got built-in fees in there because the APR is higher. So it's not just the interest rate that you want to look into, because this is a tricky thing, because I could offer you a 3.25% interest rate, but maybe it would cost you 5% to buy that interest rate down. Buying 5% to get a 3.25% rate is probably not beneficial. So anyways, there's a lot of factors, and when it comes right down to it, I hate to say it, but the truth is, the storm scared me. But the truth is that you really do have to trust the loan officer, the lending institution that you're doing business with. Because there are too many factors, even for the smart Alex out there, to try to figure out everything that they're dealing with on bank rate and, advertised on TV, what their neighbor got on a mortgage loan 4 years ago on a loan product that they don't even remember what it was. It's confusing. And so, you need to use reputable lending institutions, people that know what they're talking about, guys that do videos to explain things like this on Friday evenings whenever they should be eating pizza and soda pop with their families, okay? So, hey, I hope that the lightning goes, whoa, did you guys hear that? It's terrible, it's terrible. Everybody say a prayer for me. And thank you very much for watching. I hope that I can get home. I have an extremely small Italian sports car with a turbo, and I don't know if I can weather this weather. So, hey, I'm going to get out of here, guys. John Felici, Security National Mortgage Company.